Welcome to this video. In this video, we are going to see about Indian money market. I am Dr.M.Radhika, Assistant Professor of Economics, Sri Sharda College for Women, Salem, Tamil Nadu. Indian money market. In that, we are going to see about meaning of it, components, functions, defects of Indian money market, and what are the measures to strengthen the Indian money market. Let us see it one by one. The first one is meaning of money market. Money market deals with short-term funds. Here, it is not directly dealing with money here. Money market deals with short-term bills. That short-term bills is trade bills, promissory notes, and treasury bills, which can also be called as government bills. These short-term bills are also known as near money. So mainly it deals with short-term bills for shorter period. In this money market, where short-term credit instruments are purchased, sold, and transferred. Here, the duration is shorter period for short-term funds that may be a day, a week, a month, or it can be 3 to 6 months, but it will be within 1 year. So the period is limited to a shorter term. Here, we should know who are the lenders of money in the money market and who are the borrowers of money in the money market. So, the lenders of money in the money market are Reserve Bank of India, all commercial banks, that is, for example, SBI, like that, cooperative banks, financial institutions like Life Insurance Corporation, GSC, and UTI. Not only that, foreign exchange banks will also lend money, whereas indigenous bankers and money lenders are also included in the money market for lending purposes. The next one is borrower of money in money markets are central government, state government, local bodies, traders, merchants, exporters, importers, businessmen, farmers, and the public. So, buyers and lenders plays a major role in the money market. Here, based on the geographical locations, we can term the money market. For example, that is London money market, New York market, as well as Bombay money market. Here, we are having dichotomy nature in case of money market. That is, they are having organized sector as well as unorganized sectors. Organized sectors includes banks, whereas unorganized sectors includes indigenous bankers, moneylenders, etc. Next, we can see what are the components of money market. In components of money market, we are having call money market, collateral loan market, acceptance market, bill market, and discount market. So these are the major components of money market. We can see it one by one. First one is call money market. In this market, it is loans are provided extremely shorter period. That is, bill brokers, stock exchange dealers, those who are requiring financial needs for shorter period will get loans from this call money market. That is, the period here will be just for 7 days. So the loans given in this call money market are called call loans because the banks may demand money by recalling these loans at a very short notice. Banks prefer this kind of investment for two reasons. The first reason is uh, the call loans are treated like cash. That is, bank consider money at call and short notice as secondary cash reserve. Whenever they need, they can get it. The second reason is that bank is also getting income out of it. That is, they are earning interest on these short-term loans. But in this market, there is no need for collateral securities for these loans. Mainly, interbank call money is very common in India. Next, we can see collateral loan market. It is another specialized subsector of money market where it deals with collateral loans. That is, loans are backed by securities like stocks, bonds, etc. These collateral loans are given only for shorter period. Usually it will last for few months. The borrowers in this market are mostly brokers and dealers in stocks, shares, and bonds. In some cases, even very smaller commercial banks may obtain collateral loans from bigger banks in need of emergencies. Next, we can see the third component, that is acceptance market. This market refers to market for bankers' acceptance which arise out of inland and foreign trade. When a person sell goods to anyone, the buyer accept the bills on behalf of the customer who is the purchaser. Such bills have credit in their face value, which can be discounted anywhere. Again, some firms are called acceptance house who are professionals in this kind of trade accepts the trades bill for discount purpose. Example for acceptance market or acceptance house is London money market. Next, we can see the bill market. It is a place where short-term bills are bought and sold. This market consists of both commercial bills as well as treasury bills. The treasury bills, it is government promissory notes for shorter period. The treasury bills are purchased by the investors. Suppose if necessities arise means they are discounted with discount markets. So the last component in this money market is discount market. It is the place where all types of securities and bills are discounted to convert them into money. In this market, a safe one, but it is not watertight compartments. Why it is not called watertight compartment means these markets are related to each other. They can either borrow from other markets. That is, if acceptance house want to raise fund means they can discount them in the discount markets. So the very purpose of this market is to give financial facilities to merchants community who are in wants of urgent needs, and it can be satisfied in case of discount markets. So from these components, we are having different components in money market, but they are not interrelated. It is they are intimately related with each other, and they are dependent on one another here. So they are closely connected and depend on one another for various purposes. Next, we can see the functions of money market. The functions of money market are provides short-term funds. Mainly, it provides outlets to commercial banks, non-banking financial concerns, business corporations, and other investors for short-term funds. The next one is it also provides short-term funds for businessmen, industrialists, traders to meet their day-to-day working capital. The next function is it provides fund for short term to government and governmental agencies. The next function is it enables businessmen to invest their surplus fund for short periods. It also serves as a medium through which central bank of the country exercise control on the creation of, that is, central bank want to control credit means the first impact will be on the money itself. So it is through the money market that the impact is then transferred to the various segments of the economy. Money market uses is used by RBI to implement monetary policies by adjusting key interest rates. Banks utilize money market instruments to manage liquidity and interest rate risks in their balance sheets. So the functions of money market are more or less the same in all the country of the world, but the institutions, instruments, and modes of operation are different in different money markets. The next one we can see is the defects of Indian money markets. So these are the defects of Indian money market. The first one is dichotomy. Second one is inadequacy of banking system. Third one is disparity in rates and different centers. Absence of well-developed bill market. Seasonal stringency. We can see it one by one. Dichotomy. Here, the first defect of Indian money market is its dichotomy nature. That is, both organized banking sectors as well as unorganized indigenous bankers without any sort of cooperation between the two is that indigenous banking system consists of large number of indigenous bankers, money lenders, and credit agencies who are handling this large part of total monetary transactions of the country. In India, there are several types of unregulated non banking financial intermediaries. The most prominent of them are called finance companies, chit funds, and nidhis. They are found almost in all the parts of the country. The exact number of these companies are not available, but they are engaged in lending business. These finance companies raise substantial funds from public, whereas the resources of sponsors will be very little. The chit funds are saving institutions, but there are various types of chit funds lacking any standardized form. The absence of integration between organized banking sector and indigenous sector may results in obstacles and difficulties in Indian money market. Though Reserve Bank of India could not effectively control them nor transmit the changes in this sector through organized sector, but they have made many attempts to preview the indigenous bankers to come under the control of RBA, but they failed that. The second defects of Indian money market is inadequacy of banking system. That is, in country, India is very vast country with larger population, but the number of banks and credit institutions serving the people is small. Banking services, especially in rural India, is highly ridiculous. That is, not even 1% of Indian villages have benefits of commercial bank. But after nationalization of commercial banks and vigorous steps taken by the RBI, the expansion of rural branches have been taken. But compared to foreign countries, India has still poor records in the number of rural branches expansion. The third defect is that multiplicity of interest rates and disparity in rates in different centers. That is, multiplicity of interest rates creates a lot of confusion. There is a call rate of interest. Next, MD rate, bank rate, bazaar rate of interest, where it shows a wide diversity from 1% to 12% or even more. So the disparity of rate of interest between different business centers like Mumbai and Kolkata is still observed. The fourth defect of Indian money market is absence of well-developed bill market. A well-developed bill market would enable the smooth working of money market through credit system. But in India, the use of bill is not common, though traders are aware of the utility of trade bill to get accommodation from the Reserve Bank. The result is that credit becomes costly and money market lacks liquidity. A well organized bill market would enable the linking of various credit agencies easy and ultimately with the Reserve Bank of the country. The last defect of Indian money market is seasonal stringency. During busy season in the year, that is from November to June in our country, when lot of funds were required to move the harvested crops to cities and ports, there would be monetary stringency in money market and the rates would shoot up. This defect is being rectified by the work of RBI and seasonal fluctuations in the money rates are minimized. So, the above are the defects of Indian money market. It is exhibits the features of underdeveloped money market in our country. Lack of proper organization in our country with poor developed bill market, uncoordinated variety and multiplicity in dealing, large sections of indigenous bankers have etc. have made efforts of the RBA objective in establishing a sound banking tradition. So there is urgent need for rationalizing the banking structure to bring all banking sectors under the control of RBA. In India, we are having principal centers of organized sectors of Indian money market in the places like Mumbai, Kolkata, Delhi, Chennai, Ahmedabad, and Bangalore. Actually, Mumbai money market has been synonymous with the Indian money market. Mumbai has become the financial center of the country. Next, we can see the measures to strengthen the Indian money markets. Here, we are having stamp duty, deregulation of interest rate, introduction of new instrument in money market, discount on finance house of India Limited, money market mutual funds, and repo rate. That is the first one is stamp duty. Stamp duty was considered to be the major constraint in the use of bill system. However, experts assert that this measure is not adequate to induce the use of commercial bills. The second one is deregulation of interest with effects from 1989 by RBI. Earlier, call money was subject to interest rate ceiling of 10%. Likewise, interest rate on interbank term money was subject to ceiling of 10.5 to 11.5%. Rediscounting of commercial bills and interbank participation without risk was subject to the ceiling of 12.5%. The deregulation of interest rates has created flexibility and transparency in the transaction of the money market. The third measure was the introduction of new instruments in the money market by RBI. RBI has introduced 182 days treasury bill, 364 days treasury bills, that is long term maturity treasury bills, we can call it as dated government securities, certificates of deposits, and commercial papers. 182 days treasury bills was introduced where it is done fortnightly auctions and it has become attractive and popular, where implicit yield has increased to 11.48% during 94-95 to more than that in the year 1999. At treasury bills auctions was not held in specific periods. 364 days treasury bills plays an important role in that case also, where it also having float treasury bills where maturity periods will differ here. The next one is dated government securities. It was introduced for a maturity period of 10 years and 5 years on auction basis to make monetary instruments more flexible in order to get adequate finance directly from the markets. Certificate of deposits is also another instruments of credit in the money market by banks in multiples of rupees 25 lakhs subject to minimum issue of 1 crore. A certificate of deposit is certificate issued by a bank to depositors of funds that remains on deposit at the bank for a specific period. The maturity is between 3 months to 1 year and it is freely transferable after 45 days of date of issue. The next one is commercial bill. In case of new instrument, commercial bill, or we can call it as commercial paper, where companies, it is issued by companies with a net worth of 5 crores and in multiples of rupees 25 lakh, subject to minimum issue of 1 crore. The maturity period is between 6 months, that is minimum 3 to 6 months. It is issued at discount to face value and the rate of discount is determined by the market here. The next one is Discount and Finance House of India Limited. It was set up in the year 1988 as a part of reform for money market. It fills the long-standing needs of discount house in India, which will back bills and short-term papers from banks and financial institutions. Now, banks and financial institutions can invest their idle funds for shorter periods without disturbing their investments. Next one is money market mutual funds. It was set up in the year 1992. It is set up by scheduled commercial banks and financial institutions. The shares or units of these money market mutual funds will be issued only to individuals only. The next one is repo market. Repo is a money market instrument which helps in collateralized short-term borrowing. Measures above discussed, the money market India is showing the signs of improvement and also greater popularity. It is expected in the due course that the money market of India will become very vibrant. So these are the measures of Indian money market. So with these measures, we can improvise the standard of our money market and their operations. So these are the meanings. So thank you.